Hello. Today let's learn the concept of relevant costing, how to solve questions based on relevant costing given in the exam kit. That is what we will look into in this video. What is relevant cost? Relevant costing principles. What are these principles that are to be applied when calculating what is the amount of relevant cost? Relevant cost is a cost which would change on taking a decision. So the relevance is in terms of when there is a change in the cost on account of taking a decision. So if there is a change in the cost, then that would be called as relevant cost. What are to be included in relevant cost? So while calculating the relevant cost, there are two things which have to be included. One is future incremental cash flow. The other one is opportunity cost. We do understand that when there is a change in the cost, so it would increase incremental cost. If because of a decision, if there is an increase in the cost, we call that as future incremental cash flow. Apart from that, because of decision taken, if there is any amount of opportunity cost, that also will be part of relevant cost. What is opportunity cost? The cost of foregoing the next best alternative is opportunity cost. See, when a decision is taken, it means to say that other, if one alternative is selected on taking a decision, it means to say that other alternatives are not selected. So, among the other alternatives, there would be one alternative which is the next best. So, any benefit which is associated with the next best alternative will have to be foregone. So, whatever is foregone, the benefit that is foregone, because the best alternative is selected and the benefit foregone with the next best alternative will be opportunity cost. That also has to be included. So basically, we would be adding two things. One is future incremental cash flow plus the amount of opportunity cost. Now, a decision taken and the change in the cost, future incremental cost, and whatever is foregone would be foregone because of not choosing the next best alternative. That is opportunity cost. We also have to remember what are the items which should not be included in relevant cost. See, basically anything which is already incurred, historical sunk cost, committed cost. See, they would not change because the decision is already taken, the cost is already incurred, historical sunk cost. They would not change because of the decision taken. So, therefore, they would be avoided here. See, we see one such thing. Then depreciation. Depreciation is amount which is um, calculated and spread over the life of the asset. See, it's a commitment made at the time of purchase of the asset. So now, specifically on account of taking the decision, there would be no change in the amount of depreciation. So that also should be excluded. Any decision taken, there are few costs which would be incurred no matter what the scenario is, they are unavoidable in nature. So the unavoidable costs also would not be included. They are excluded because there is no impact of the decision on these costs. Therefore, they do not form part of the amount of relevant cost. There are certain costs which are incurred as common firm-based costs. See, for the entire organization. For example, top management salaries like managing director salary, people at the strategic level, see the directors who are there, their salaries, then some common costs which are incurred for the entire firm, they are incurred, and these costs are allocated to different departments. Fine. Then in that case, these fixed overhead costs, they would not change because a decision is taken. So apportioned fixed cost or the costs that are allocated to the departments which are incurred as common firm-based costs. So they also will not change. So that is to be excluded. Apart from that, all financing cost also should be excluded. Financing cash flows like, see, fixed interest amount, fixed preference dividend. See, those items are to be excluded. So, simple equation. Let's remember what is relevant cost. Relevant cost is equal to future incremental cash flow plus the opportunity cost. Let's quickly look at what are the questions that are given in the exam kit, and answer that one by one. Let's take them up. The first question says that UU company has been asked to quote us for a special contract. The following information about the material needed has been given. So there's material X, which we are talking about. For this material X, there is original cost, scrap value, replacement cost. Done. The contract requires 10 kgs of material X. There are 250 kgs of this material in inventory, which was purchased in error over 2 years ago. If material X is modified. So now here, until this point, we do understand that for this special contract, the requirement of material is 10 kgs, but they have already purchased 250 kgs of that material 2 years ago, which is already available with them. So if it is available right now, they do not have to purchase these 10 kgs, because 10 kgs can be taken out of 250 kgs. And then if material X is modified at a cost of $2 per kg, it could then be used as a substitute for material Y, which is in regular use and currently costs $6 per kg. So what is this sentence? What does this sentence mean? It means to say that if material X is modified, there is an alternative use for material X. That is, material X can be used as a substitute for material Y. That is the point here. Now, by using these 10 kgs for this special contract, they will forego the chance of using this material X, this 10 kgs of material X, as a substitute for material Y. So they have to forego that. When they have to forego that, then that will be called as an opportunity cost. See, if they use it as a substitute for material Y, they will be saving $6 per kg. So that cost saving is foregone, because material Y can be purchased at $6 per kg, which now they do not have to, they would not be able to avail it, they would not be able to save it. So that is foregone. But this possibility of $6 per kg is cost, which can be saved, is possible only when this material X is modified at a cost of $2 per kg. So this part of the sentence will be talking about the opportunity cost. Right now, is there any future incremental cost? No, because the material is already available. They would not be spending anything on purchase of material X. It is only the opportunity cost. So let's put the solution in an Excel file. One second. I have put the data in Excel file. Okay. Let's answer the question. Question number 72. Okay. How do we, let's first define what is relevant cost. Formula, relevant cost is equal to future. I'm writing it here once. Future incremental cash flow plus opportunity cost. So for question number 72, do we see that there is any future incremental cost? There's nothing, because the material is already available. There is no future incremental cost. It is zero. But we do see that there is an opportunity cost, that they would be able to save, they would be able to save $6 per kg, but that is a possibility only after spending $2 per kg. So technically speaking, the cost savings are to the extent of $4. That is, we see that $6 can be saved but after spending $2 on modification cost per unit into, we see that there are 10 units. So we have it as future incremental cost is equal to 6 minus 2 applicable for all 10 units, which is equal to 40. So option B is the answer. I hope that's clear. Let's answer question number 73. Let's read the question from the PDF file. VB company has been asked to quote for a special contract. The contract requires 100 hours of labor. However, the laborers who are each paid $15 per hour are working at full capacity. There is a shortage of labor in the market. The labor required to undertake this special contract would have to be taken from another contract Z, which currently utilizes 500 hours of labor and generates 5,000 worth of contribution. If the labor was taken from contract Z, then the whole of contract Z would have to be delayed, and such delay would invoke a penalty fee of 1,000. What's the relevant cost of the labor for the special contract? GUB has been asked to quote for a special. There is again another special contract. Then the contract requires 100 hours of labor. However, the laborers are paid each at 15 hours, $15 per hour, are working at full capacity. This is the key point. See, though the contract requires 100 hours of labor, labor are paid at $15 per hour, and right now additional labor is not available because all of them are employed at full capacity. So there is no spare capacity in terms of labor hours available. There is no such scenario. Then we see that there is a shortage of labor in the market. The labor required to undertake this special contract would have to be taken from another contract Z. So in the market also labor is not available, shortage of labor, which currently utilizes 500 hours of labor and generates 5,000 worth of contribution. Done. Apart from that, we do see that if the labor was taken from contract Z, then the whole of contract Z would have to be delayed. And as such, they would invoke a penalty of 1,000. So now they will have to pay this 1,000 penalty fee. That is a future incremental cost. Because, see, because the market does not have available labor, there is shortage of labor in the market. So what is that they have to do? The labor required to undertake this special contract will have to be taken from another contract Z. Done. Because of undertaking the contract labor from contract Z, and there is a delay in the work, but there is nothing as such they would be foregoing. Work will be delayed, the contribution still will be earned, work would be delayed. When the work is delayed, the the delayed work is attracting a penalty of 1,000. Done. How many hours are required? 100 hours. 100 hours, and each hour will be paid, compensated at a rate of $15 per hour. Fine. So let's go to the Excel file and then solve the answer there. 73rd question, we see that relevant cost is equal to future incremental cash flow plus the opportunity cost. There is no opportunity cost, there is only future incremental cost. But two categories we see that future incremental cost is one, they are using 100 hours into each is paid at the rate of $15. Plus, apart from that, they also have to pay a penalty of $1,000. Okay. So here it is equal to 100. We see that 100 into 15 plus another 1,000. So the answer here is 2,500. Okay. So workers are paid at the rate of $100 hours into $15. They are taken from another contract Z, but the work is only delayed. There is nothing foregone. So they are generating a contribution of $5,000 worth by using 500 hours. So we don't have to look into this part of it because the reason is the work is delayed. So contribution still will be earned little later. Because of this delay, this is attracting a penalty of 1,000. So we don't have to do anything with this second paragraph. Future incremental cash flow will be the cost that is paid to the workers plus the penalty fees. Do not take anything as opportunity cost because nothing is foregone. I hope that is clear. Let's go to the next question. Question number 74. An organization is considering the cost to be incurred in respect of a special order. Special order opportunity. The order would require 1,250 kgs of material D that is readily available and regularly used by the organization on its normal products. There are 265 kgs of material D in inventory, which cost $795 last week. The current market price is 3.24 per kg. Material D is normally used to make product X. Each unit of X requires 3 kgs of material D. And if material D is costed at $3 per kg, each unit of X yields a contribution of $15. What is the relevant cost of material D to be included in the costing of the special order? So there's a special order. We are asked to calculate what is the relevant cost of material D. Material D, for this special order, the requirement is 1,250 kgs of material D. Done. And there are 265 kgs of material D in inventory, which cost $795 last week. See, last week we are not bothered because that's historical in nature. The current market price of the material is 3.24 per kg. Material D is normally used to make product X. Material D is available, but that material D which is available, is it available to be used in product in the special order? No, because material D is normally used to make product X. So we do not have the possibility of using material D for the special order. The current market price is, each unit of X requires 3 kgs of material D and D is costed at $3 per kg. Each unit of X yields a contribution of 15. See, since we are not considering using this 265 kgs of material for this special order, in that case, what will be relevant cost? So let's quickly go to the Excel sheet and solve the answer there. So question number 74. The relevant cost is equal to future incremental cash flow plus the opportunity cost. Now, future incremental cash flow and opportunity cost, if we look into that, see, 1,250 kgs of material is required. Can that be taken from the existing inventory? No. 265 kgs are available. That is one thing. But this 265 kgs of material D, which is already available, is normally used to make product X. So when it is already used for making product X, the question about whether it can be used for the special order does not arise. So what does it indicate? It indicates that the entire amount of 1,250 kgs of material have to be purchased at the current market price. The current market price is here, we see here, each unit of X requires 3 kgs of material D, and if material D is costed at $3 per kg. So that has to be purchased at a cost of $3. So here it is $3. So the current material cost is 3.24, not 3. The current market price is 3.24. 4050. The this cost of $3 per kg is each unit of X requires 3 kgs and it is costed at 3, but the current market price is 3.24. Okay. Current market price is 3.24 and 1,250 into 3.24, we have this as 4,050. Let's go to the next question. Question number 75. In order to utilize some spare capacity, K is preparing a quotation for a special order which requires 2,000 kgs of material J. K has 800 kgs of material J in inventory. Original cost is $7 per kg. Material J is used in the company's main product L. Each unit of L uses 5 kgs of material J, and based on an input value of $7 per kg of J, each unit of L yields a contribution of $10. The resale value of material J is 5.50 per kg. The present replacement price of material J is $8 per kg. Material J is readily available in the market. The relevant cost of 2,000 kgs of material J to be included in this quotation. Okay. For a special order, the requirement of material is 2,000 kgs. Okay. Then 800 kgs of material J is available. 8K has 800 kgs of material J in inventory. See, when it was purchased at 7. So that is sunk cost, that is historical. So it is not relevant. Material J is used in company's main product. So if it is used in company's main product, then the question about whether it can be used for the special order would not arise here. Each unit of L uses 5 kgs of material J, and based on an input value of $7 per kg of J, each unit of L yields a contribution of $10. The resale value of material J is 5.50. The present replacement price of material J is $8 per kg. Material J is readily available in the market. It is available. So now we have to find out what is the relevant cost of 2,000 kgs of material J. So let's quickly go to the Excel sheet and present the solution there. So for question number 75, the requirement of material is 2000 kgs. Though there is 800 kgs of material available in inventory, it is being used for making the main product L, so it cannot be used. So all 2000 kgs of material J has to be now purchased. If that is the case, the price at which it can be purchased is it is $8. So now relevant cost is equal to 2000 into 8. So that is 16,000. Option C is the right answer. Let's take up the next question. 76. A company is calculating the relevant cost of the material to be used on a particular contract. The contract requires 4,200 kgs of material H, and this can be bought for 6.30 per kg. The company bought 10,000 kgs of material H some time ago when it paid 4.50 per kg. Currently, 3,700 kgs of this remains in inventory. The inventory of material H could be sold for 3.20 per kg. The company has no other use for material H other than on this contract, but it could be modified it at a cost of 3.70 per kg and use it as a substitute for material J. Material J is regularly used by the company and can be bought for 7.50 per kg. So there's a lot of information here. We see that for the special contract, the requirement of material is, we see that 4,200 kgs of material H is required. The current market price is 6.30 per kg. Done. The company bought 10,000 kgs of material H some time ago, where it was purchased for 4.50. But at present, 3,700 kgs of material is in inventory. The inventory of material H could be sold for 3.20 per kg. So there is an alternative use which is mentioned for the available inventory, which is 3,700. 3,700 kgs of material H is available. This can be used for the special contract. Requirement is 4,500, but out of 4,200, out of 4,200, 3,700 kgs are already available, which need not be purchased now. That's one part of it. But there is a suggestion that this could also be sold for 3.20. So there is an opportunity cost which is arising here. So each unit can be sold at a price of 3.20. Done. That's one piece of information. Another thing, the company has no other use for material H other than on this contract. So all 3,700 kgs of material can be used on this contract, but it could be modified at a cost of 3.70 per kg. If it is modified at a cost of 3.70 per kg, then it can be used as a substitute for material J, and material J as of now can be bought at a price of 7.50. So if they use it as a substitute for material J need not be purchased, which is at present costing 7.50 per kg. So they will be saving cost on material J to the extent of 7.50. But that is possible only when it is modified, the modification cost, when it is modified at a cost of 3.70 per kg. We see two alternatives available for this 3,700 kgs of material. 3,700 kgs of material could be sold. One alternative is could be sold for 3.20. Another alternative is this can be used as a substitute for material J. By using it as a substitute for material J, they will be able to save 7.50 minus 3.70. So there are two alternatives available. So in terms of opportunity cost, we need to take into consideration both the alternatives. The best alternative will become the opportunity cost. Let's quickly go to the Excel sheet and then solve the answer there. See, if we talk about what is relevant cost, the same formula holds good here as well. This is question number 76. Multiple details are there. So let's carefully sort it out. I'm writing all the details in detail. We see that material requirement is 4,200. Material available is 3,700. Material to be purchased so is equal to 4,200 minus 3,700. What's the current market price? We see current market price of material is 6.30, $6.30. So this has to be purchased. These 500 kgs of material, they have to be purchased at a price of 6.30. So future incremental cash flow will be 500 into 6.3. Next, we also have to now look into opportunity cost. For the calculation of opportunity cost, there are two alternatives. So let's first talk about alternative one. Alternative one, what is alternative one? That the material, the inventory of material H could be sold for 3.20. Okay, alternative one, material can be sold. Material can be sold for $3.20, which is equal to 3,700 kgs into 3.20. Done. Alternative 2. Let's write what is alternative 2. What's alternative 2? That this material can be used as a substitute for material J. So the second alternative which is available is can be used as a substitute for material J. By using it as a substitute for material J need not be purchased, which is right now available at a cost of 7.50. So there would be cost saving to the extent of 7.50. But that is available only if they modify it at a cost of 3.70. So what's the opportunity cost? We have it as cost saving on purchase of material J. Now, how much is the cost saving? Cost saving is 7.50. So we see that there is a cost saving of 7.50, but after modification cost of 3.70. So the total cost saving is, we see 7.50 minus 3.70 into how many kgs? See, the material that is available is 3,700 kgs. So this is applicable for all 3,700 kgs. So we see that there are two things. Alternative 1, opportunity cost on alternative 1 is 11,840. On alternative 2, it is 14,060. Okay. So when in case there are two alternatives, see, we have to understand the next best alternative is the opportunity cost. So between the two of them, the best one is 14,060. So this will be opportunity cost. So what is relevant cost? Relevant cost is future incremental cost, which is 3,150, plus the opportunity cost, which is the next best alternative. Best alternative between the two of them is 14,060. So we have it as 14,060. Add both of them, and that becomes the relevant cost is equal to, we have 3,150 plus 14,060, which is 17,210. Option 1 is the answer. Let's solve the next question. Question number 77. AS Limited is considering a new project that will require the use of a currently idle machine. The machine has a current book value of 12,000 and a potential disposal value of 10,500 before 200 disposal cost, and hence has been under depreciated by 1,500 over its life to date. If the machine is to be fit for purpose on the new project, it will have to be relocated at a cost of 500 and refitted at a further cost of 800. Okay. What's the relevant cost of using the machine on the new project? See, there is an idle machine which is right now available, which can be used in this new project, but there is also some mention about the machine has a current book value of 12,000 and the potential disposal value, potential disposal value. It can be used on this project. It can also be sold for 10,500 after spending 200 disposal costs. So possibility of disposing it is an opportunity cost. So there is an opportunity cost which is present, which is 10,500 after spending 200 disposal cost. So 10,300 is opportunity cost. After that, we see that, and hence has been under depreciated by 1,500 over its life to date. That is irrelevant completely. Whether it was under depreciated, over depreciated, whatever was the scenario that happened in the past, that has no relevance as of now. So we just ignore this 1,500. Apart from that, if it were to be used, if this machine were to be used on this new project, the incremental costs are, they have to be relocated at a cost of 1,500 and a further cost of 800. So relevant cost is future incremental cash flow. Future incremental cash flow is 500 plus 800. Done. That is 1,300. Apart from that, we see that there's an opportunity cost to dispose this at a value of 10,500 after 200 disposal cost. So these things have to be taken into account. So let's quickly write the solution in Excel sheet. So we see relevant cost is two aspects. One is 77. 77 is um, the question is about use of an idle machine. There are two aspects. One is about future incremental cash flow. If the machine were to be used on this new project, they have to spend on relocation 500 plus another 800 has to be spent on this machine so that it can be used. Apart from that, there is an opportunity cost. Opportunity cost is that it can be sold at 10,500 after incurring a disposal cost of 200. Done. So what's relevant cost? So relevant cost, we see that it is 1,300 plus 10,300. So 11,600 is the answer. We see option C is the answer, 11,600. Let's also answer the next question. Question number 78. Blunt is considering a new project but is unsure how much overhead to include in the calculations to help him decide whether or not to proceed. Existing fixed overheads are absorbed at the rate of $8 per hour worked. Blunt is certain that the project will involve an incremental 500 labor hours. The project will involve extra machine running cost, and these variable overheads cost him $4 per hour. The number of extra machine hours is expected to be 450 hours. The difference between this figure and 500 labor hours is above is expected idle time. The project will require a little more temporary space that can be rented at a fixed cost of 1,200 for the period of hire. This overhead is not included in the fixed overhead absorption rate above. What is the overhead to be charged to the project? What is the overhead to be charged to the product? See, this project will require 500 labor hours. We see that fixed overheads are absorbed at the rate of $8 per hour. And that's one part of it. But they are absorbed. There is no future incremental cost on account of fixed overheads. Done. So that this piece of information, $8 per hour fixed overheads that are absorbed becomes irrelevant for us. Second part of it. Then we see that variable overheads cost him $4 per hour. The number of extra machine hours is expected to be 450 hours. The difference between this figure and 500 labor hours is above is expected idle time. See, they see that there is an incremental number of labor hours that are required are 500 incremental labor hours. Okay, that's one piece of information. But they would be paying only for 450 hours. The number of extra machine hours is expected to be only 450 hours, not 500 hours. The difference between 400 and between 450 and 500 is 50, that is idle time. So if it is variable cost will be spent on the number of hours that are worked. So we would have it as 450 into 4. That's one piece of information. Next, apart from that, we see the project will require a little more temporary space that can be rented. So they now have to spend on rent at a fixed cost of 1,200 for the period of hire. Done. So we see that there are two costs as of now. We see that fixed overheads are also given, but they are absorbed. That's a book adjustment. There is no future incremental cash flow on account of fixed overheads. So that should not be taken. Variable overheads cost him $4 per hour. That should be calculated for 450 hours. That's one part of it. Second part of it is that they have to take a space on a rent basis at a fixed cost of 1,200. So only fixed future incremental costs are there. There is no opportunity cost. So write the solution. Let's write the solution here in the Excel sheet. We would see that only variable overheads plus rent for temporary space. So this will be 450 hours into dollar 4. This is one part of the cost. Plus another part of the cost is the both of them are future incremental cost, which is 1,200 is equal to 3,000. 3,000 is option A. That's the answer. Hope that's clear. Let's answer question number 79. Question number 79 says that Clever Clocks is short of labor for a new one-off project needing 600 hours of labor and has choices as to where to source this. They could hire new people temporarily from an agency at a cost of $9 per hour. Alternatively, they could recruit new temporary staff at a fixed cost of advertising of 1,200, but then only pay $6 per hour for the time. They could also redirect some staff from existing work who are currently paid $7 per hour and who make sandals that generate a contribution of $3 per hour after all variable costs. Sandals are a good selling product and Clever Clock will lose the production and the related sales while staff is working on the new one-off project. What's the relevant cash flow? Let's sort out all this information. The requirement is for 600 hours of labor and has choices as to where to source this. Where to source. So then there are alternatives that are available. First alternative is they could hire new people temporarily from an agency. So hire from an agency is first alternative, and that requires hiring at a cost of $9 per hour. Second alternative, they could recruit new temporary staff for which they will have to pay fixed cost of advertising at 1,200 and then pay only $6 per hour for the time. So the second alternative, that is recruiting new temporary staff, will involve a cost of fixed cost of 1,200 plus a variable cost of $6 into 600. Okay. The third alternative, they could also redirect some staff. They could also redirect some staff from existing work who are currently paid $7 per hour and who make sandals that generate a contribution of $3 per hour after all variable costs. Okay. Sandals are a good selling product and Clever Clock will lose the production and the related sales lose the production. It is not delay in production. In one of the previous questions, we saw that there was a delay. Here it is about losing the production and the contribution that can be generated on account of that. Okay. Sandals are a good selling product and Clever Clock will lose the production and the related sales while staff is working on the new one-off project. What's the relevant cost? So we see that there are three alternatives that are available. So when there are three alternatives that are available, we need to find out what's the relevant cost. Question number 79. Question number 79. Relevant cost is equal to future incremental cash flow plus opportunity cost. Three alternatives as mentioned. See, let's write all the details first. Number of labor hours needed on this one-off project is equal to, we see that 600 hours are needed. Now, let's keep mentioning about what are the alternatives that are available and then jot out these things. Alternative one. If it is alternative one says that they could hire new people temporarily from an agency. Hire from an agency. Okay. So what's the cost? Cost of hiring from the agency. We see that it is equal to, they could be hired, they could hire new people temporarily from an agency at a cost of $9 per hour. How many hours is the requirement? 600 hours into $9, which is equal to 5,400. Let's now write what is alternative 2. Alternative 2 says that they could recruit new temporary staff. Recruit temporary staff. This recruiting temporary staff will involve two types of costs. One is fixed advertisement cost, which is equal to 1,200. Then they also have to pay the workers at the rate of $7. Okay. That's a variable component. Variable cost will be, we see that 600 hours paid at the rate of $6, not 7, $6, which is equal to 3,600. So we have cost of recruiting temporary staff is equal to, we have 1,200 plus 3,600, 4,800. That's alternative 2. Then we have another alternative, alternative 3. Alternative 3 says they could also redirect some staff. Redirect staff from existing work. See, when they redirect staff from existing work, they are paid at the rate of $7 per hour. Then here in this case, there is a future incremental cash flow, which is $7 per hour. There is also opportunity cost. That is opportunity cost is they will have to forego $3 per hour. So we see the relevant cost in this case. One is future incremental cash flow, which is we see 600 hours are paid at the rate of $7 per hour, plus they will have to forego $3 contribution, okay, who make sandals that generate a contribution of $3 per hour. As many number of hours they use on each hour, whatever is the contribution per hour, that has to be foregone. That's the second part of it, which is an opportunity cost. So now we see the relevant cost for alternative 3 is equal to 600 paid at the rate of 7 plus 600 on all 600 hours. There's a contribution that is foregone is 3. So we see that there are three values. We see one is 5,400, one is 4,800, the other one is 6,000. What's the relevant cost? There are three alternatives available. See, in terms of cost, the alternative which has the least cost is the relevant cost. So least cost would be selected, which is 4,800. This is the answer, 4,800. I hope that's clear. See, one last question which is remaining. Let's also answer that one. See, after 79, we see that 80 is a theory question. 81 is also theory question, which are very simple. Please read through the study text material and answer those two questions. 82 is one last numerical question on relevant costing. So we will also answer this part of it. So it says that XPLC intends to use relevant cost as the basis of the selling price for the special order, the printing of a brochure. The brochure requires a particular type of paper that is not regularly used by XPLC, although a limited amount is in XPLC's inventory, which was left over from a previous job. The cost when XPLC bought this paper last year was $15 per ream, and there are 100 reams in inventory. The brochure requires 250 reams. The current market price of the paper is $26 per ream. The resale value of the paper in inventory is $10 per ream. See, whatever was XPLC bought this last year for $15 per ream is not relevant cost. It is irrelevant because last year's price, not historical cost. There are 100 reams in inventory, but the brooch requires 250 reams. So how many more reams do they have to purchase? 150 reams. Done. The current market price of the paper is $26 per ream. So that has to be spent. Apart from that, the ones which are there in inventory, 100 reams, have a resale value. So for that part of it, there is an opportunity cost. Okay, so let's quickly solve the solution in Excel file. This is question number 82. paper reams required? Totally 250 paper reams are required. Available inventory is 100. Paper to be purchased. We see that it is 250 minus 100, 150. Done. After that, what's the cost of paper ream? We have this as $26. Then find out what's the cost incremental cash flow, future incremental cash flow. Is equal to 150 into 26, 3,900. Done. We do see there is an opportunity cost. What is the opportunity cost? 100 reams of inventory is available, but that has a resale value of $10 per ream. So opportunity cost is, we see it is 100 reams into each can be sold at 10. So relevant cost is equal to the sum total of these two items, which is 3,900 plus 1,000. 4,900, and the answer is B, 4,900. I hope this is clear. Please follow this carefully and learn the solution. Okay. I'll meet you in the next video with another topic.